Good afternoon. This Tuesday, April 4th, and of course, Turnaround Tuesday came to be in the grain trade after the explosive movement to the upside on Friday, which followed through on Monday with, of course, oil prices helping elevate the situation. But came to pass, first trading day of the month did find some highs, and the market went on retreat. The surprising retreat, and we'll talk about that, is the wheat market, which they did show that the crop ratings yesterday afternoon, second worst crop on record since they started keeping records in 1986 for crop ratings. Basically, well over half of Kansas is in the poor to very poor category. A third of the overall winter wheat crop for the hard red winter wheat is in poor to very poor category. So why in the world did the Kansas wheat market sell off today? Well, I'll show you. When I get to the chart, I'll show you the standout at $9, but this is the reason. They came out this morning already. When you look at the 15-day model, you go past the 10-day models, they all of a sudden bring moisture into Kansas and into the panhandle, potential rain for this area. Will it do any good? Likely not. In the end, you're going to have 1 million acres that are going to get put out on the insurance. With that, you're going to have some other wheat acres that maybe can come back, but it's not going to be an explosion of production because in the South, it's already starting to head. It's not going to help anymore. But whether crop improvement of substance can occur if these rains arrive like potentially forecasted, and we know how this can disappear in 2 days. It disappears, but it doesn't stop the market from getting a correction. And in yesterday's newsletter, we stated, we probably did a 1, 2, 3 up already off the lows. The low came in just after our 60-day cycle change, and now we're setting up for what would have been an A last week. The B wave was Monday, and now we're working our way into a C wave setback, which can then be labeled 4 before we head on higher again. Now, something to note here, the two runs at $9 here, you would have thought would have had exciting closes, but there's absolutely no close higher than this one right here at 877 3/4. So all this trading action up here near $9 never gets solidified on the close. It always falters. So that prospect of a C-wave sell-off on all this friendly news, even though they'll probably milk the rain whether it comes or not, could pull us back here in the 840 range on a wave C movement because world values are not moving up. We have French milling wheat, which is also correcting nonstop since last week. It never did enjoy the rally that Chicago and Kansas City wheat had on Monday. It did, but it closed lower on the day, and today pressed lower. Now, this could be a wave 2 pullback after a longer 5-wave series down like Chicago wheat, and so we're pulling back into a wave 2 setback before another elevated push could run it back higher into the spring. But maybe that tied to May ending of the safe grain corridor, as Russia implies will occur. So we'll see how that plays out. So coming back to Kansas City wheat, we're probably in a C leg of an ABC correction, which could get nasty in here. I can't imagine how, but they somehow do it. We could re-challenge our moving average resistance or support at 852, which lines up with the 4-hour chart as well. You can just see it climbing up here. It's up to 850 already. It doesn't take much for Kansas City wheat to quickly find its way down there before another leg's up. And then, of course, you can just see here how you have a 1 and a 2 and a 3, and here comes Lawrence Welk, 4, and then a 5th wave. And that could time into our next 60-day cycle, which starts end of April through the opening of May, which would be very seasonal. April 23rd is a synonymous date. Here's April 24th, a Monday. That would be a perfect date for a high if we get some kind of explosive move. And that would probably coincide with the rain never arriving. Or maybe it turns into snow, and that would be something similar to, I think it was 2018, we had a bunch of snow, and that brought in a May 1st high for Kansas City wheat. Now, moving on to corn. We had been stating back at the early part of March, this was a wave 3 of a larger 5-wave decline down. And we said a wave 4, ABC could push to the 200-day moving average, if not push through it. Now, it's important for wave 4s that don't close above the bottom of wave 1. And how convenient. The high the other day at 68.5 was just shy of wave 1. And then, of course, we turned down. Now, we don't have confirmation that this is a 4 because we've got to get back under the 200-day moving average and make this whole thing a flop. And if that occurs and we get under the 200-day moving average, and more importantly, I'm going to say about 647 on a daily closing basis. We got to get through this moving range stuff. These 4-hour bars, there's 6 bars in a day that play out on these things. Actually, it's about 3 bars to a day because we're closed from 1:20 until 7 o'clock. But still, you can get my point. You get multiple bars underneath, more importantly, 645. Then you have a 200-day moving average failure. and then this will be labeled 4, and then we'll be on our wave 5 decline into the summer months. Hard to envision it in the current situation where beans could still be lifting, but that's how the count gives us a setup. New crop corn, failure to advance anything beyond last week's highs. We have 92 million acres. We'll see what North Dakota, South Dakota, Minnesota get planted after we shovel out from our over a foot of snow we're going to get today through tomorrow. But after Easter, we do have very warm temperatures on the way. There's going to be some flooding, but nonetheless, we'll probably get the small grain crops rolling here. Some portions of the state, southwestern part, northwestern part of the state of North Dakota, will get small grains going here in a week or two. But upside potential on weather spikes does keep this market limited to 580 range, where the moving averages start to continue to collude lower. Now, summer spikes, we get out here in June and July, whatever the weather is, that's what it's going to take to bolster a big rally here to punch up to the $6 range. Just a reminder to subscribe to Heartland Investor Capital Management's newsletter services. It's not just a newsletter. It's videos like this twice a week. We have 3 newsletters during the week with a highlighted one on the weekend, morning text in the morning telling you what has been happening around the world affecting the overnight trade and what to look forward to in today. And then, of course, we have our trade alerts that can go out through the day at any time. And every now and then when there's a heightened story that's affecting the market during the day, we tell you about it during the day via phone text. So subscribe to heartlandinvest.com's newsletter at this link. Daily continuation soybeans. Well, we've had to recount this thing as we stated last week. I believe every technician out there has this thing wrong. We go back to last summer's low from the highs that were made in the spring, which are probably ultimate highs. We had a wave A correction down, and we're still working the B wave out. And we can subdivide it. Then we have an A up. I can do a little A, B, C up into this A. Then I can do an A, B, C down into this minor A, and then you've got a B, and then I can do a wave down to a C. This takes your A, B. You see how confusing Elliott wave can get? And then from there, I can subdivide it in multiple ways, but I don't want to use the letters right now. I can come to the point where the spring high, which we thought was the high, the February high, is now just a minor A with a minor B, and we're in the final minor C of a larger C to a wave B before this market ultimately puts in a high and then declines later on this year. And you have to go back to the whole start of this thing. Here's your bottom that was created back in 2020. Actually, we go back to 2019. And this was your wave 1. This was your wave 2. Here was wave 3, wave 4, wave 5. Your ultimate top was here. Now, typically, when you have this initial A wave low and we thought that this thing was the B wave high, it should have pushed through the highs of the spring, giving us our ABC pattern up. It never did. We just thought it was that bearish. Well, surprise, surprise. It's not. The market was wrong for its break, creating that V bottom, and now we are pressing back higher, which should ultimately somehow into May or June carry these beans to $15.75 to $16. Stay tuned. November beans, we're probably close to a wave 1 advance after our ABC pullback. Setbacks would be labeled as a wave 2 with a wave 3 punching through trendline resistance tied to some weather scare on only 87.5 less million acres of beans planted. We need every single one of these beans to produce, and maybe we'll see some beans picked up from corn. That's what the price needs to do. I want to talk about cattle today, the April cattle market. We showed this channel movement of how you could pretty much well define everything since last fall. You could just see when they were crowding the channel, we knew that some point in time a sell-off was coming. Notice how where volatility is picking up. We pierce the channel now, implode, hold, pierce the channel, blow through, pierce the channel, and now we're retreating. Now in a super bull market, we'll retreat and hold the breakout this time and advance again. But when we look at the June cattle, doesn't look anything like those channels. We're widening our volatility. We have a bull trend in place. We can take last year's June, July lows, tag with October, and that hooked the major break that we had experienced in February on all these recession fears. But on the top side, that channel is very defined as well, like the April cattle contract, but unlike the April cattle contract this time, we did make new contract highs, but we couldn't push through, heightening that this area is smaller than the volatility of this area, meaning our volatility, obviously, Sherlock, is getting bigger. Now, this recession talk won't leave us, and I highlight this because here we've pushed to new highs. This is a good time now if you're considering to use LRP, livestock risk protection. This really works really good in this scenario here for insurance to come into play because the volatility getting larger versus back here means our options are getting more expensive. And so the scenario for using livestock risk protection starts to become heightened now. And it's something to work at because we just continue to find stories that knock us back. And this current correction we're in, if it's not just a simple 2-day pullback that turns back up, we're going to be having a date with 158 again here real soon before new bullishness can probably resurface and carry this market higher. So again, livestock risk protection insurance, pretty ideal in here in this time zone. U.S. dollar breaking down on the manufacturing numbers coming out today, and we have our jobs number at the end of the week. This market's getting set for a breakdown here, which ultimately is friendly for commodities, but it takes substantial moves of 4 or 5% to make a big deal. So you start breaking the dollar down to 95 on the handle here. Oh, that'll bring us some exports. But, moving mildly 1 or 2% isn't going to do it just yet. But what it did move was gold on to new highs for the calendar year high. We did not take out March highs of last year, which seems like we're targeting that. We have our turn date for the 10th. We'll see how that plays out. The last one was a continuation run versus the prior one. The lows came in afterwards. Here we got slid right through. As you can see, kind of losing the power. They had more power before. It seemed like we could, within a day or two, time the turns. But now it's getting much more difficult. But we'll see here. Just as soon as we don't think it's difficult, it gets easy. Maybe we do get some kind of high into the early part of next week or from the jobs number on Friday morning at 7:30. The crude oil market bolting through our purple line that we've been talking about and showing you for quite some time. We have been stating, we had said after March 15th, the late seasonal for a spring rally gets underway. We said we had to get through our March 21st turn date. That did occur courtesy of another bank going broke before rallying late last week. Then, of course, the OPEC numbers gapping us over our purple line. Now, here's what I want to reveal to you. As we've stated before, we could always gap or jump the purple line, but could never stay 3 closes above, and we'd always fall out of bed. Well, I'd say tomorrow we will successfully be 3 closes above the purple line, which will confirm we have our lows, but pullbacks on any new recessionary stories will probably find support at this number until we can start breaking through major resistance at 83. So in a nutshell, we can confirm we have our lows. Setbacks are to be bought. And here, basically, this gap on the charts will be something targeted for buying on the next bearish news the stock market wants to throw at crude oil. It's Eugene Grainer with Heartland Investor Capital Management. I hope you find this information useful.